Imagine hitting refresh on your portfolio, and boom, one of your stocks is down 99%, just gone in months.
Yeah, that's pretty catastrophic.
So today, we're really digging into that story. It's SUNation Energy, ticker SUNE, a solar company that's seen, well, a meltdown. What did the research you pulled together show?
It shows a company facing, let's just say, significant headwinds. That 99% drop, it's not just noise, it signals something fundamental.
Absolutely. So this is our deep dive into SUNation Energy. We're looking at, their business, the financials, who's in charge, where they sit in the market, and what the future might hold, based on what we know as of today, April 12th, 2025.
Right. And we've got stock reports, some industry data, the company's own press releases, ownership filings, quite a bit to sift through.
Okay, so our mission here is to really cut through that, extract the key stuff, and figure out what's actually going on with SUNation Energy, beyond just those shocking headlines. Ready to unpack it?
Let's do it. That value destruction is definitely the place to start.
All right. So, first things first. Chapter 1, Business Understanding. What does SUNation actually do day to day?
Oh, okay. So according to the sources, they're focused on installing and servicing solar panel systems. Pretty standard there. But they also do battery storage, Tesla Powerwall, and phase and charge are mentioned specifically, and EV chargers.
Okay, so the whole home energy package, kind of.
Yeah, and interestingly, roofing services too. Their main spots are Long Island in New York, the Tampa Central Florida area, and Hawaii. They operate as Hawaii Energy Connection there.
It sounds like they had bigger plans, though, like buying up other companies.
That was the idea, yeah. The stated ambition was this acquisition-led growth, buy up leading local solar companies.
Okay.
But, and this is, well, pretty crucial right now, with their market cap down around, what, $100,000? And that recent financing deal, which was incredibly dilutive.
We'll definitely get into that later.
Right, that whole acquisition strategy is just, it's not feasible. They don't have the money. And their stock isn't exactly prime currency for deals.
Yeah. Can't buy much when your own wallet's empty. So acquisitions are out. How do they make money now? What's the actual business model?
It's described as vertically integrated, so they handle, design, installation, maybe service afterwards.
Right.
Revenue comes from selling and installing those systems, solar storage. Then there's service contracts under SUNation service. Roofing projects bring in some money. And then there's this e-gear technology.
E-gear. What's that? Sounds potentially interesting.
It's described as patented edge-of-grid energy management, devices, battery storage, meant to optimize home solar systems.
A patented tech sounds good. Is it? Is it actually making the money?
That's the thing. The sources mention it, highlight the patent, but there's not much on, commercial success or how much revenue it generates. So could be early days, could be struggling to gain traction. Hard to say. It's kind of a question mark.
Okay. So they call themselves a leading provider.
Yeah.
But that market cap, 100 grand. How do we square that? What's their real position?
Yeah, leading provider needs context. They're a nano cap stock. That typically means under $50 million market cap, so they are tiny in the grand scheme.
Right.
They're really a regional player.
Yeah.
Concentrated in NY, Florida, Hawaii. Now, the SUNation brand is strong on Long Island, voted best solar business there for years. That's real value locally.
But managing multiple brands, SUNation, Hawaii Energy Connection, e-gear, maybe old Pineapple Energy stuff too. Sounds complex for a small, struggling company.
It could definitely add complexity, yeah. Especially when you need to be lean and efficient, which they desperately do right now.
So if I'm a homeowner thinking about them, what's the pitch, the value prop?
It's the standard solar appeal, really. Energy independence, lower bills, sustainability. Plus, they emphasize quality, 25-year system guarantee, lifetime workmanship warranty, trying to build trust.
Okay, so summing up Chapter 1. They install solar, storage, EV chargers in a few key regions. The grand acquisition plan is dead for now. Revenue comes from installs, service, roofing, maybe this e-gear tech someday. But they're a very small regional player, despite the local Long Island strength. The key seems to be they're in a growth industry, but their own problems are stopping them from really benefiting.
Exactly. Internal issues seem to be overriding the positive industry backdrop, especially with competition and those tariffs we need to talk about looming.
Right. Okay, let's shift gears. Chapter 2, Management Evaluation. Who's steering this ship? And are they doing a good job, given the circumstances?
Well, the key players are Scott Maskin, the CEO. He founded the original private SUNation, and James Brennan, who's both CFO and COO.
Maskin founded the original company. That sounds promising initially.
Yes, his track record with the private entities seems positive, but his leadership during this public company's catastrophic decline, that obviously raises serious questions.
Mayor Brennan, CFO and COO. That's a lot, especially in a crisis.
It is. He has a long history with SUNation, strong credentials on paper, but again, he was part of the leadership team while all this value destruction happened. And holding both roles, especially when an interim CFO resigned, it's not usually a sign of stability.
No, definitely not. And the sources mentioned some insider buying just before the collapse.
Yeah, this is pretty notable. December 2024, Maskin, Brennan, another director, they bought shares between $2.80 and $2.85.
Wow. And then months later, pennies and massive dilution.
Exactly. It suggests a, let's say, significant misjudgment of the company's immediate financial health and prospects at that exact moment. Makes you wonder what they were seeing or not seeing.
Doesn't build confidence, does it?
Yeah.
So how did they respond to the crisis hitting? What actions did they take?
They took some pretty drastic steps, restructuring to cut costs. They secured that $20 million financing, but again, hugely dilutive, like wiping out a massive chunk of existing shareholders' ownership. A big chunk of that cash, about $12.6 million, went straight to paying off debt and settling obligations. They changed the name back to SUNation, reincorporated in Delaware.
Standard moves in distress sometimes.
And, crucially, got shareholders to approve a massive increase in authorized shares. They needed that to issue all the new stock for the financing.
So they stopped the immediate bleeding, maybe, but the cost to the original owners was immense.
Pretty much. Saved the company structure, perhaps, but torched the prior equity value. Classic tough choices in distress.
Have they been upfront about all this? How's the communication?
They've been pretty active with press releases, SEC filings, detailing the changes. There was an investor presentation laying out the turnaround plan, so the information flow is there.
Okay.
However, the framing is consistently optimistic, which, you have to weigh against the harsh reality of their situation, and that delayed 10K filing. That's usually not a great sign either.
Right. Optimism needs backing. What about ethics? Any red flags beyond just destroying shareholder value?
The sources don't point to outright scandals or unethical behavior from this management team, but the sheer scale of value destruction, combined with those really tough financing terms, it definitely raises questions about stewardship and decision-making. Even if the financing was necessary, the terms were brutal for existing shareholders.
Okay, so let's hit those key management questions. Honest, capable, shareholder-oriented.
Honesty. Seems okay on the reporting front, maybe with an optimistic spin. Capability. Highly questionable given the public company's performance versus the private one's history under Maskin. Shareholder-oriented. For anyone holding stock before this recent dilution, it's a clear no. Survival and the new financier seem to be the priority now.
Makes sense. So where is the money going now? Capital allocation.
Right now, it's all about survival and balance sheet repair. That $20 million went mostly to paying down debt, settling old scores, not really growth investment.
The M&A is definitely off the table.
Completely. They might talk about it long term, but it's not happening now. No share buybacks, quite the opposite. Massive issuance, no dividends, no prospect of dividends. And return on invested capital, almost certainly deeply negative. They haven't been making money on the capital they've had.
And then Bitcoin. What was that about? Seems odd for a company in their position.
Yeah, January 2025, right in the middle of this financial storm, they announced a Bitcoin treasury strategy, allocating some of their very limited cash to Bitcoin. Seriously, it seems highly questionable, maybe imprudent. Bitcoin's volatile, speculative. How does that help stabilize a struggling solar installer? It raises real concerns about judgment and capital allocation priorities. Feels more like a gamble than strategy.
Okay, Chapter 2 recap. Management has a mixed past. The crisis response involved painful dilution. Communication is active, but maybe overly rosy. Capital's focused purely on survival. And the Bitcoin thing is, well, a head-scratcher.
Yeah.
Key insight seems to be that leadership prioritized survival, but at the expense of prior shareholders, and made some questionable calls along the way.
Exactly. The focus shifted entirely to keeping the lights on, funded by new money on tough terms, not building value for the old equity base.
All right, this is probably where it gets really grim. Chapter 3, financial health. Let's hit the numbers. What did the key metrics look like?
Yeah, it's not pretty. Market cap, like we said, tiny, around $100, very volatile. Price to earnings, not applicable. They lose money, deeply negative.
Revenue.
trending down year over year, quarter over quarter. Gross margin reported around 28-33%, but that's likely under pressure, especially with costs rising.
And profit margin.
Operating margin, net profit margin, both deeply negative, somewhere between maybe negative 14% operating and negative 17% to negative 37% net, depending on the period. They're losing significant money just running the business.
What about the debt? They paid some down, right? Did that help the ratios?
It would have improved the debt-to-equity ratio from what was likely a high level, but free cash flow is still negative. They're burning cash. Price-to-book ratio is near zero. Seems cheap, maybe, but the price-to-tangible book value, that's negative.
Negative tangible book. Explain that.
It means their liabilities are actually greater than the value of their physical tangible assets. It's a really critical warning sign about financial fragility. And EPS figures, massively negative. Hundreds of dollars per share, negative, reflecting huge losses.
Wow. So just to recap the metrics. Unprofitable, declining revenue, negative margins top to bottom, and negative tangible equity. That's bleak. What about overall financial stability, beyond just those numbers?
Historically, earnings have been super volatile, mostly negative. They had positive EBITDA in 2023, then swung back negative in Q1 2024. Analysts, if they even cover it, don't see profits this year. Earnings have declined over the last 5 years.
Dividends.
Non-existent, no capacity for them. Debt management was obviously poor leading up to the crisis. They've deleveraged now, yes, but stability is still very fragile.
Liquidity. Can they pay their bills?
Weak. Negative working capital. Very low liquidity ratios, quick ratio around 0.35, current ratio around 0.45, both way below 1. That signals potential trouble meeting short-term obligations. Even with the recent financing cash, the ongoing cash burn means their operational runway might be shorter than they hope. The core issue is profitability and solvency.
So, Chapter 3 takeaway. Financials are dire across the board. Unprofitable, weak balance sheet, even post-debt reduction. Volatile history, low liquidity, ongoing cash burn. High-risk profile.
Absolutely. This isn't a growth story right now. It's a survival story, and the odds aren't looking great based on these numbers.
We need to take a quick pause here. When we come back, we'll get into what the market makes of all this and who actually owns SUNation Energy now. Stay with us. We want to tell you about a really cool tool that can help you, get these kinds of insights on your own whenever you need them.
Imagine this. You can generate a full report, like a detailed podcast or even a video analysis on any stock whenever you want.
And what if that analysis was tailored to you? Like, your level of financial knowledge, how deep you want to go in each area.
At stockanalytics.ai, we're not just imagining it, we're building it. We're creating a platform that lets you do all of that. And we're taking it even further. We're adding an interactive interface where you can ask specific questions about the stock, a voice-controlled stock screener to find your next great investment, and even a sophisticated portfolio analyzer that'll help you manage risk and stress test your holdings.
Don't wait. Go to stockanalytics.ai today and check out our demo. You can see the power of this technology firsthand. We've opened up our waiting list for beta users, and early adopters get 50% off. Plus, you might even get a chance to invest in the future of, financial intelligence.
Sign up now at stockanalytics.ai. You don't want to miss this.
Welcome back to the deep dive. We've been picking apart SUNation Energy. Now it's time for Chapter 4. Market sentiment. What's the vibe out there? What does the market think?
Overwhelmingly negative. I mean, the 99% stock price collapse kind of says it all, doesn't it?
Right, sums it up, yeah.
Trading volume has been massive. Lots of people rushing for the exits. It's seen as almost worthless. Technicals might show oversold, but in a fundamental collapse like this, those signals don't mean much. Confidence is just gone.
What about Wall Street analysts? Are they still covering it? Any price targets?
It's almost tumbleweeds. There's a real lack of credible current analyst coverage. Any targets you see floating around are probably ancient history, pre-dilution, pre-reverse split maybe.
So those numbers like $1.53 or even $75 are just meaningless noise.
Pretty much irrelevant now, yeah. The fact that serious analysts aren't covering it tells you a lot. It's too small, too distressed, too speculative for most institutional desks. The silence is deafening.
Okay, so the pros have largely walked away. How did the market react to the recent news? The financing, the debt paydown, did that help at all?
Not really, judging by the stock price. The company pitched it as stabilizing, a step forward, but the market seems to have viewed it as desperation, dilution, just kicking the can down the road. It didn't inspire confidence that the underlying business was fixed. Skepticism is really high.
And the short interest. I saw some crazy numbers reported.
Yeah, it's exceptionally high. Figures vary, but some sources suggest over 50%, maybe even higher, depending on how it's calculated and the timing. A huge chunk of the available shares are shorted.
People betting heavily against it.
Exactly. And the cost to borrow those shares to short them, extremely high. Over 200% annualized sometimes, reportedly peaked even higher. That shows intense bearish conviction.
Could there be a short squeeze?
Unlikely to be sustained. The days to cover is low because trading volume has been so high during the collapse. Without fundamental improvement and with more shares outstanding now after the dilution, any pops are probably just speculative blips, not a real squeeze based on fundamentals. The overwhelming bet is still downwards.
Got it. So, Chapter 4 recap. Market view is about as negative as it gets. Stock collapse, high volume, no real analyst coverage, good news met with skepticism, and massive short interest with high borrowing costs.
Yep. The market has basically given up on the existing equity value. Extreme pessimism prevails.
Okay, let's move to Chapter 5, ownership structure. After all this chaos, who actually owns SUNation now?
Well, the picture has definitely shifted. Institutional ownership is very low, maybe 1% to, say, 26%, depending on reporting lags and the new shares. Very few traditional institutions involved. BlackRock had tiny holdings before. Maybe some new distressed funds came in with the financing.
For the insiders, management.
Also low percentage-wise, post-dilution. Remember those ill-timed buys in December?
Yeah.
Their stakes are much smaller now relative to the total shares.
So who does own significant chunks?
Hedge funds. Activist investors, distressed funds. Names like L1 Capital, Bigger Capital, Savvy Management, District 2 pop up. They hold a significant chunk, maybe 15, 16% or more collectively. The top 25 holders control around 37, 38%. It's concentrated among these types of players.
And the rest.
The general public. Retail investors, probably around 60, 65%. Pretty typical for these highly volatile, speculative situations. Key takeaway, ownership shifted from maybe some long-term holders to opportunistic, distressed specialists and retail speculators.
Doesn't sound like a recipe for stability. What does that ownership mix imply?
Well, low traditional institutional support signals a lack of confidence in the long-term fundamentals. Low insider ownership might mean less alignment with remaining common shareholders. The distressed funds? Their goal is maximizing their return, which might involve pushing for things that don't help other shareholders. And the large retail base can fuel volatility.
How did corporate governance play into this, those shareholder votes?
Governance moves were basically about enabling the survival plan. Shareholders approved increasing the authorized shares vital for the dilution. They approved giving the board authority for reverse split. They approved the share and warrant issuance for the financing.
So the mechanisms work to allow the restructuring, but at the cost of dilution.
Exactly. Presented as necessary for survival, but the direct result was prioritizing new investors and debt holders over the existing common shareholders. The move to Delaware is another governance footnote. The proxy statement from March probably has the nitty-gritty details.
Okay, Chapter 5. Low institutional insider ownership. Significant control by distressed funds, lots of retail, and governance moves that facilitated the painful dilution. Now for the big picture assessment. Chapter 6. Risk assessment and the SWOT analysis.
Right. The SWOT analysis really lays it bare. Strengths. Okay, they have the local SUNation brand on Long Island. They're in a high-growth industry generally. They did cut debt recently. They offer a range of services. There's that e-gear potential, maybe. And the founder is back as CDO.
Okay, some positives. But the weaknesses?
Oh, they're huge. Extreme financial distress, fragile balance sheet, negative tangible equity, low cash, massive dilution just happened, poor public company track record, nano-cap scale, operational complexity, huge execution risk for any turnaround, reliance on intangible assets that might be worthless. It's a long list.
What about opportunities? Any hope?
More speculative, really. A potential turnaround if everything goes right. Growth in their existing markets, maybe, if e-gear takes off. Long-term M&A, if they ever get capital again. Maybe falling interest rates help eventually. And, short-term speculative trading, but that's pure gambling.
But the threats?
Yeah.
They sound much more real, especially those tariffs.
Absolutely critical threats. Number one, those 2025 U.S. tariffs. We need to dig into those. Then just basic liquidity risk, insolvency risk. They could run out of cash.
Right.
Intense competition. Execution risk can they actually pull off a turnaround. Policy risk, solar incentives can change. Interest rate risk, supply chain problems, reputational damage from all this. And delisting risk from the NASDAQ, the weaknesses and threats just dwarf the strengths and opportunities right now.
Let's focus on those tariffs, the 2025 ones. How bad are they, specifically for SUNation?
They are a very big deal. We're talking tariffs from 24% up to nearly 50% on solar panels from key Asian suppliers, plus tariffs on cells, inverters, steel, aluminum, even battery systems.
And SUNation installs this stuff. So.
Yeah. Exactly. They rely on importing these components, so their cost of goods sold is going to jump significantly across the board.
Can they just pass that cost on?
Very unlikely in a competitive market, especially when they're already struggling. It'll crush their already negative gross margins. It means lower profit per job, maybe projects get delayed or canceled, they become less price competitive, maybe overall demand even slows down, plus more supply chain headaches. It's a massive external shock hitting them right when they're weakest. It seriously undermines any turnaround hope.
So the tariffs alone could be a killer blow.
They certainly represent a formidable, potentially insurmountable headwind. It makes a tough situation dramatically harder.
Okay, Chapter 6, Conclusion. Limited strengths, massive weaknesses, huge threats, especially those tariffs hitting their core costs. The risk profile is just extremely high.
That sums it up well. High risk, low reward potential based on the current picture.
Which brings us to Chapter 7, our brief wrap-up based on everything: the business, the management, the financials, market view, risks. What's the final verdict?
From a value investing standpoint, it's a clear negative. As of today, April 12, 2025, SUNation Energy looks like a company in critical condition.
No competitive advantage, weak finances.
Right. No real moat, critical financial weakness, questionable management execution in the public sphere, awful market sentiment, extreme risks like tariffs and insolvency. Intrinsic value seems negligible, frankly.
So a value trap. Looks cheap, but isn't.
A classic potential value trap, yes. It appears unsuitable for investment right now. There's a very substantial risk of total loss for anyone holding the common stock. It's, yeah, a very tough spot. Now, while that's our main conclusion from the deep dive, there was one kind of unusual aspect that popped out. Makes you wonder a bit.
You'll have to wait for our next deep dive to hear about that. But for more analysis like this one, definitely subscribe to the Stock Analytics AI YouTube channel.
Yeah, please do.
And just a reminder, everything we discussed today was based purely on the research materials provided for this deep dive, and AI did help structure our outline.
That's right.
Okay, so that intriguing aspect you mentioned, thinking about all the chaos, the near collapse, and that, let's call it surprising Bitcoin investment. What if, just hypothetically, way down the road, that Bitcoin bet actually paid off big time? What would that mean, given everything else?
Yeah, that is a fascinating wrinkle, isn't it? Talk about unpredictable outcomes.
Definitely something to ponder. Well, thanks everyone for joining us on this deep dive into the very turbulent world of SUNation Energy.
Yeah, thanks for listening. We always appreciate hearing your thoughts, too.
Let us know what you think. Until next time, this has been
The Deep Dive.